Hello, everyone. My name is Carrie Larson. I'm an annuity specialist here at Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Athene. Today, we'll be talking about the basics of annuities, the annuity spectrum, the advantages of fixed index annuities, and how to choose an annuity based on your client's profile. We are joined by Scott McClure, Business Development Wholesaler with Athene. Before I turn it over to Scott, I just want to mention that if you have any questions throughout the presentation, you can type them into the chat box on your screen. All questions will be answered at the end of the presentation. Without further delay, I'm turning it over to you, Scott.
Well, thank you, Carrie. I very, very much appreciate the opportunity. Scott McClure, your business development wholesaler here with Athene Annuities. Want to thank Carrie and everyone at Art Jetter for allowing us the opportunity to go over some of the annuity basics with you folks today. Going to start out with how annuities are put together and how fixed index annuities work. Again, I am Scott McClure, your business development wholesaler here at Athene Annuities. So jumping right in, let's talk about why annuities. Well, going to go back to 2016, over $220 billion worth of annuities were sold in the U.S. 117 billion of those were fixed and fixed indexed annuities. So what are the key reasons that clients do purchase fixed indexed annuities? Fixed annuities, well, mainly the main reason is going to be for safety and protection. All of our annuities are going to have 100% downside protection. Fixed indexed annuities generally always will have 100% downside protection. And also, a lot of those clients are going to be looking to these contracts for income, retirement income. There are a lot of great contracts out on the market that can offer guaranteed income for life. So how are annuities typically sold to the client? Usually from the carrier, they'll either go through an independent marketing organization, like Art Jetter, a broker-dealer, or a bank, and then through the agent or advisor directly to the customer. So an annuity contract, it's a contract between an individual and an insurance company, and in exchange for the premiums paid, the monies may accumulate in the contract on a tax-deferred basis. They may also be paid out all at once or in a stream of payments over time. So some of the most common uses for annuities are to save for retirement or to create a dependable retirement income stream, a guaranteed income that you can't outlive. Also, we see a lot of rollovers from traditional IRAs, from 401ks, or retirement pension plans. So a deferred annuity, there are actually two different types of annuities, deferred and immediate. A deferred annuity generally accumulates tax deferred for more than 1 year before the payments begin. And very often it's much longer than 1 year. We see durations 5, 7, 10, 15 years. Payments can come via withdrawal or an annuitization. Now, in an immediate annuity, payments can begin within 12 months of the policy issue. They always are going to in an immediate annuity. Also, now, annuitization converts an annuity balance into a stream of payments, and the payments can continue for a fixed amount of time. That's what we're going to call a period certain, say 5 or 10 years period certain, or can be guaranteed for life. And also, a lot of times they can have a lifetime component with a period certain guarantee as well. So again, payments can be for life or can be for just a fixed period of time. So annuities also can be single premium or flexible premium. A single premium is going to be purchased with a single lump sum payment. Some single premium annuities accept additional premium during a short specified period of time at the beginning of the contract. Some may allow you to add more money during that first contract year. Some will not allow you to add any money after that first initial payment. And some will allow you to combine funds from two different sources not available on the same day. So most annuities are going to be able to, you're going to be able to fund them with more than one funding source, but then after it's issued, you may not be able to add to it. Also, issue age guidelines are important. Flexible premium payments on a flexible premium annuity are going to be accepted for longer periods. So For example, you might have a fixed rate product where they will accept premiums into the contract. We actually have premium fixed index annuities or fixed annuities where we will add premiums in 5-year, for example, a 5-year guaranteed annuity where you can add in the second, third, fourth, or fifth year, and it will not increase the surrender charge period. So those are going to be your flexible premium annuities. Most fixed index annuities are going to be single premium and not flexible. Again, that varies by company and also by the contract. And then there are going to be issue age guidelines. So contracts often define the minimum and maximum issue ages. Very often a maximum issue age could be 80 to 90. That's getting up around the higher issue ages. And again, sometimes annuities you can get in as young as 1 year old, and sometimes you have to be 35 or 40 to get into the contract. It just varies by the contract and by which product you're using with each particular company. So now let's talk about Annuity Tax Basics. So we'll talk about accumulation versus payout. And during accumulation, interest earnings accumulate on a tax-deferred basis in an annuity. So annuities are going to be tax-deferred. Clients will not have to pay interest on the gains until they take that money out of the annuity. No tax due until the funds are withdrawn, no 1099, and they will allow those interest payments to compound and earn interest on the money that would have been paid in taxes if it was not in a tax-deferred vehicle. Now, during payout, if payments are withdrawn, earnings are taxable as ordinary income. The earnings are withdrawn first, so it's going to be last in, first out, which means the first out will be the earnings. Withdrawals before age 59 and a half may incur a 10% tax penalty. So anytime you have money in a deferred annuity, you cannot take that money out before 59 and a half without a 10% IRS tax penalty. If payments are annuitized, a portion of each payment is considered a return of premium. Okay? Now, that's going to be on your non-qualified. Non-qualified is going to be after-tax personal investment money. Premiums returned tax-free. The earnings are taxed as ordinary income. Then on your qualified annuities, those are going to be your IRA money, 401k money, retirement plan money, usually funded with pre-tax dollars. All payments are taxed as ordinary income. So all of that money has not been taxed before. So when you do withdraw it from the annuity, 100% of the qualified money is going to be taxable as ordinary income. The annuity does not provide an additional tax benefit for qualified funds. So let's talk about withdrawal and surrender charges on annuities. Most annuities assess a charge if withdrawals are made during an initial surrender charge period. So charge is typically a percentage of the amount shown. The surrender periods may vary by contract. Again, we've got contracts as short as 3 years, as long as 15, so there are some various durations for different annuities. Common surrender periods, again, 5 to 15 years. Now, generally, annuities will offer some sort of liquidity during the surrender charge period. Most contracts allow for some liquidity during the surrender charge period before the surrender charge applies. So the free or penalty-free withdrawals that are available each year can be, generally speaking, between about 5 and 10% of the premiums. That's very common. Again, certain contracts may have a little more liquidity, or you could also add a liquidity rider. But remember, all withdrawals are subject to tax on earnings, and withdrawals taken before 59 and a half may be subject to that additional 10% excise tax from the IRS. Okay? Again, these are tax-deferred vehicles. If you withdraw the money before 59 and a half, the clients will incur a 10% excise tax. So, additional liquidity provisions. Well, we do have many waivers. Many contracts include special benefits to aid with financial needs that arise under various circumstances. So the waivers may allow for penalty-free withdrawals up to specified limits if certain conditions are met. Common waivers include nursing home and confinement waivers, also terminal illness waivers, and very often we can see some home health care waivers as well. Waiver availability and terms may vary by company, by contract, and by state where the contract is issued, or by many other criteria. So certainly be careful. There are a lot of states that will not allow certain waivers on the contracts. So certainly be sure that you're checking on all the features of any contract that you're looking to sell, just so you're giving the client that correct information. Also, RMDs, required minimum distributions. The tax code requires most qualified plans to begin taking income by 70 and a half. Many issuers allow RMDs to be taken without penalty. We do at Athene. Again, many annuity providers will allow RMDs to be taken out penalty-free. Also, there are income riders available on many annuity contracts. So many contracts offer income riders, optional benefits usually available for an additional cost that guarantee a specified minimum level of income, often for life. So a lot of times there will be a lifetime income rider available on a fixed indexed annuity that will guarantee your clients, again, lifetime income as long as they live. Generally speaking, and again, this is generally speaking, those lifetime income riders, once you turn them on, that insurance company will pay that income amount as long as the clients are still alive. So let's take a look at some of the bonus provisions that are available, and they may apply under certain conditions. Common provisions would be a common bonus. We have premium bonuses that are available. A lot of our contracts have additional value credited to the contract at issue. Also, just so you are aware, most of those contracts are going to have a recapture schedule if the withdrawals are made before a specified period of time. So, for example, if the client is going to surrender the contract before the surrender charge period is up, very often there will be a bonus recapture schedule where some of that bonus would be recaptured depending on what year the client surrenders the contract in. Also, some contracts are going to have a persistency bonus, additional value credited to the contract if the contract stays in force beyond a specified time frame. Also, some are going to have some very nice income bonuses. So if it is an income product, very often additional value will be applied if certain withdrawal or annuitization payment options are elected. So these, again, are going to vary contract by contract, provider by provider, and certainly the availability is going to vary by contract and state. So make sure you're taking a look at what's available for each provider and each client in each state that you're looking to work in. Now let's talk about the guaranteed minimum benefit riders. This is going to be an income rider. They are very popular, optional feature on many fixed indexed and variable annuity contracts, usually offered for an additional cost or fee. So usually that income rider does come with a cost. It's going to guarantee a specified level of income, usually for life, and usually that income is still going to be available even if the contract value reaches zero. So that's the true benefit of the lifetime income riders. Even if you run through all of your money and anything you may have earned, then the insurance company will make those income payments to you out of their pocket. It is payable as a withdrawal, not an annuitization. So the annuitant maintains control over the remaining contract value. That's really a big feature of the new income riders. Again, the clients do not have to annuitize the contract, and they still are going to be guaranteed that income for life. So really a nice benefit for many clients looking for income in retirement. Contract defines maximum amount available before withdrawal. And so that's often based on the annuitant's age at the time guaranteed payments begin. Payout rates increase if income is taken at an older age. The length of time the contract was held before the guaranteed annuity payment begins. So income factors typically roll up by a specified rate each year. Some can go up every year. Some will be banded and go up every 5 or 10 years. Excess withdrawals may decrease the value available for subsequent guaranteed payments. So it's very important. If you do have a client who is using a contract for lifetime income payments, if they do take excess withdrawals, very often, in most cases, that will decrease their future income payments. So have to be certain that you have a conversation with your clients. If they want the best lifetime income available, probably not a good idea to take those excess withdrawals from your income contracts. Now let's talk a little bit about the death benefits available on fixed index annuities. Death benefit, if annuitant dies before the contract maturity, generally this death benefit is going to bypass probate if properly named beneficiary. With an annuity contract, if you have a named beneficiary, it should bypass probate and just go directly to the named beneficiary. Again, one of the benefits of an annuity contract. Excuse me. Also, the death benefit is paid directly to the beneficiaries, and that can be in a lump sum. It can be over a 5-year period, for example, or it can also be over a lifetime. So really depends on how the client wants to take that death benefit and what options they have in the contract. So let's take a look at the type of contracts now. There are fixed indexed annuities, there are fixed annuities, and there are variable annuities. Now, fixed annuities are going to multi-year guarantee product, maybe 3.5% for 5 years, something like that. The company is going to declare that interest rate, and the company may offer multiple terms. So, for example, with Athene on our fixed products, we do have a 3, 5, and 7-year duration available called the max rate. Again, those are all just straight fixed rate products and do allow additional premiums. So those fixed rate products are very nice for the conservative clients or folks who really just want to know what interest rate they'll be earning. Then the next option is our fixed indexed annuity. The owner earns regular interest. The interest is based on a portion of the return of one or more of the indices. So with this, your clients are going to pick an index, one or more. They can certainly use more than one. And their returns are going to be based on tracking a index. So the company defines how the index earnings will be shared, and the company guarantees that the interest credit will never be less than 0. So one of the benefits of fixed indexed annuities is you won't go backwards. You're 100% downside protected. So again, in the fixed annuity, you can earn interest, but you won't go backwards from any index losses or any index movement. So also, then next on the index or the annuity list is going to be the variable annuities. The owner may earn interest depending on the return of their sub-account. So in a variable annuity, all the investment is going to be on the client. The client's going to pick the sub-accounts they want, and depending on how those sub-accounts perform, that will depend on how their annuity performs. Sub-accounts are similar to mutual funds and may rise or fall in value. This is going to be a contract where you're actually in the market. So variable annuities are considered securities and require a securities license to sell a variable annuity. Now let's talk a little bit about interest rates, fixed rate annuity basics here. Interest rates. The company guarantees that an initial deposit will earn a specified rate for a specified period, typically 1 year or longer. Then with renewal rates, after the initial guarantee period, the insurance carrier will declare new rates for subsequent periods, may be higher or lower depending on the interest rate environment at the time of renewal, and may have different terms than the initial period. For example, some contracts may offer multi-year initial periods, but only a 1-year renewal period. So those rates can change at renewal. Talking about minimum guaranteed value, the company declares a minimum guaranteed rate below which the crediting rate will never fall. That is established at the time of purchase and implies for the life of the contract. So now let's talk a little bit about market value adjustments. That's a charge that may apply when the money is withdrawn or transferred before the end of a guarantee period. It's going to be defined by the company in the contract, and it's typically related to changes in interest rates over time. So if general interest rates have risen, since the guarantee was established, the MBA generally will result in a charge or deduction to the contract value. If interest rates have fallen since the guarantee was established, the MBA will result in a credit or an increase in the contract value. And again, those MBAs really don't come into play unless your clients surrender a contract early, or if they go above and beyond the penalty-free amount. That's the only time that you would see a market value adjustment being applied. So let's take a look now at the spectrum of annuities and the risk and potential of those particular annuities. So with the low to moderate return range, those are going to be really your CDs, your bonds, or your straight fixed annuities, okay? A moderate return is going to be something that your clients would be much more likely to find in a fixed indexed annuity. Again, a fixed indexed annuity has no market risk potential and is going to have safety and potential of a fixed indexed annuity. Really just a better way to get some great returns without having to be in the market. So again, kind of that middle ground between the fixed annuity or CDs and bonds and the stocks and mutual funds and variable annuities, kind of a little bit safer product, but still offers some pretty nice returns in that fixed indexed annuity. So then looking for potential higher returns, if your clients are shooting for the fence, they're looking for those high returns, that's where they're going to be looking at stocks, mutual funds, and variable annuities. And certainly with stocks, mutual funds, and variable annuities, there is much, much more risk to the client. Obviously, they can lose all or any portion of that investment. So fixed indexed annuity basics, let's talk about some terms, initial and renewal rates. As with fixed annuities, indexed annuities include term lengths, generally 1 or more years. They do have initial cap rates assigned to the annuities contract at the time of purchase, applicable to the term rate. Now, they can be caps, they can be participation rates, or they could also be spreads. And just 3 different ways to credit interest to those annuities. Renewal cap rates are declared after each index term and apply to the next index term. The minimum guaranteed values are declared at contract issue and apply for the life of the contract. They may be set by a formula as well. So just to reiterate, let's think about a fixed indexed annuity. It is not in the stock market. So when your clients are in a fixed indexed annuity, they're earning interest based on tracking an index, but the money is never invested in the index or in the market. Fixed indexed annuities, the interest rate is linked to the portion of the upside performance of an outside market index. So a lot of different indexes we see out there, potential for greater interest crediting compared to traditional fixed indexed annuities. We see that fixed indexed annuities do offer better interest potential than just straight fixed annuities. And the indices vary from company to company. Most companies will have the S&P 500. A lot will have the Dow Jones Industrial Average, the NASDAQ 100, the Hang Seng, the Euro Stock 50. Really a variety of alternative indices are available today. But again, the S&P 500 is going to be the most common index to track in an indexed annuity. So let's talk about crediting on the indexed annuities. The index may move up or down, and the accumulated value increases as the index interest is credited based on upward movement of the index. So it's linked to, not equal to, the market index return. So again, there are a variety of ways you can be credited on that index return. The accumulated value does not decrease if the index movement is negative or flat. So that's where we have the downside protection in a fixed indexed annuity. Your clients will never lose money due to an index loss or an index decrease. So let's take a look now. Fixed indexed annuity basics. Let's talk about cap, spreads, and participation rates. I just mentioned this a couple of slides ago. Um, with a cap, the interest credit is going to equal the return of the underlying index up to the stated cap. So for example, if we have a 5% cap and you're in that index, your client's going to earn whatever that index does up to that 5% cap. If they earn 3% in the index, they'd get 3. If they earn 4, they'd get 4. If the index returns 6% and there was a cap of 5, they would be capped at that 5%. So again, the example is a 5% cap. If the index earns 3, they get 3. If the index earns 5, they get 5. If the index returned 9, they would be capped at 5%. So that's how a cap works. Let's talk about a spread now. With a spread, the return of the underlying index less the stated spread is what the client will earn. I think of this one as a hurdle rate, if you will. So the example, if you've got a 2% spread and the index did 3%, the interest credit for the client would be 1%. It would be, again, that 3% minus the 2% spread. If the index credit was at 5%, then the client would be credited 3%. Again, that's the 5% minus the 2% spread. And if that client had earned, or the index, I apologize, had earned 9%, then the client would get a credit equal to 7%. Again, 9% minus that 2% spread. Okay? Now let's talk a little bit about participation rates. With this one, the return of the underlying index is multiplied by the stated participation rate. This is what Athene likes to use because this is not going to put an upper limit on what your clients can earn. So for an example, if we were at a participation rate of 50% and the index did 3%, your client would earn 50% of that return, 1.5%. If, again, we were at a 50% participation rate and the index earned 5%, the interest credit would equal 2.5% to your client. And if, again, that client had earned 9% over that crediting period and we're at a 50% participation rate, the client would earn 4.5%. So again, participation rates are nice because they do not put an upper limit on what a client can earn. We actually like the participation rates, again, just for that very reason. We're not capping the upper end of what a client could earn potentially on their annuity. So interest crediting strategies. This is the approach used to measure the amount of interest credited to an annuity as a result of a change in the index. So common strategies are going to be just a straight fixed rate. We've got those on all of our contracts, just a 1-year guaranteed rate. Also, we very often will see a 1-year point-to-point, and we'll take a look at where the index is on the day the contract's open and look at it 1 year later, and we'll look at the increase from a specified date to the one a year earlier, and we'll give that client that percent of change, again, up to the cap or applying the participation rate. Also, there is monthly average. With monthly averaging, it's the percentage of change in the index comparing the beginning index value to the 12 monthly average index value. So on that one, we're going to take a look at what the index does every month. We're going to average it out and see what the change has been over that 12-month period. We also do have monthly caps. This works the same way as the point-to-point strategy, but it's actually on a monthly basis. So after 12 months, we're going to add up all 12 of the monthly percentages, changes, and add them together, and that will be what your clients earn on the monthly cap. So just to summarize how a fixed indexed annuity or fixed annuity can really help your client, first and foremost, it's going to give them safety and protection. Provides great upside potential with no risk of loss. So that's really huge. This is people who don't want to worry about those market risks, have very, very good feelings about fixed indexed and fixed annuities. Also, they're available for income. We, as well as our competitors, have many great income products on the market. They all will have tax deferral. There are certainly death benefit options available in many of these contracts, and they're going to have a variety of liquidity options. Again, some will have free nursing home withdrawals if you're confined to a nursing home. Some will just have penalty-free withdrawals depending on how the contract's written, various amounts, terminal illness, or confinement waivers as well. So at this point, Carrie, I'm going to throw it back over to you, and we can certainly answer any questions if you guys have them. If not, I'd like to thank you very, very much for your time. If you do have any questions, talk to one of the marketers at Art Jetter. I know you've got some great annuity specials there. Again, this is Scott McClure at Athene. Let me know if there's anything else that I can do to help. Are there any questions out there?
It looks like we just had one question about the slides being available, and yes, this is recorded, so I will make sure to get that out to everyone. And first, I want to say thank you to you, Scott, as well as everyone else who joined us. We encourage all you to start thinking about people who are a fit for an annuity product. To get appointed with Athene, please visit our website, www.jetter.com, and click Get Appointed. Our team is standing by if there are any further questions, or if you'd like additional training information, please call us at 1-800-228-0008. Again, thank you all for attending, and enjoy the rest of your day.